Welcome to this episode of SidekickTV. Today I'm joined by Cam Irvine of Irvine-Wenborn Wealth. I've pulled in Cam for this because he's an expert in the stock exchange, both here in New Zealand and also in America. Now, today's video is a bit different. It's actually a recap and review of the movie Dumb Money on Prime and also the docuseries Eat the Rich on Netflix. So hopefully if you listen to this, it will give you the context to go enjoy those movies. I hope you enjoy this video. Please like and subscribe where you're watching or listening to this. Thank you. So with that scene set of what we're talking about today, the first question I've got for Cam is, basically what is it, this shorting thing? I mean, we think of shares in New Zealand and we think of Ryman and Meridian shares, right?
Yeah.
What is this?
Shorting, there's two answers here. The short answer to what shorting actually is betting against a company or its share or stock value going down. The longer answer is you can think of typical investment as we're buying something, you're going to be an investor in it and hold it because you want to see the value go up. In Wall Street investing world, they call this long. You go long a company, which means you're holding on to it for the long term. Shorting is the opposite of that. When a company is falling in value or going downhill, what you can actually do is go short, which is saying, I think this is going to keep going down. So I'm borrowing those shares and then selling them off to somebody else because they're going to continue to drop in value. So I can make money from that. It's a little bit cannibalistic. It's not necessarily the way that most people make their money, but it is an option out there. And what that means is you're potentially preying on companies that drop in value and taking advantage of that. Another term for it is called cigarette butt investing, because the idea is that when somebody else is done with that company, you're picking up the cigarette butts and getting the last drag of it. So it's not really the glorified version of investing, but it's saying that, hey, this is going to lose value. Is there a way to make money from that? And the answer would be yes.
In the movie, there's the scene where it gets bailed out. The Melvin Capital gets bailed out, and that just gets people irate again because they're like, all of a sudden, Wall Street again wins. Thousands of people lose their jobs, and yet the really wealthy guys just make more money.
Yeah, it's a bit gross, honestly, but it also demonstrates a couple of interesting lessons here. One is that we as people think that we remember these things that take place. We remember the 1987 share market crash. We remember the global financial crisis. But what do we end up doing? A lot of the same things that put us back in those positions anyway. And it's not to point fingers and say, oh, it's all our fault or all theirs. Though I am not a big fan of Wall Street and the hedge funds industry. But that being said, we do continuously forget that these things happen, and then we get put in a risky situation where bailouts need to take place, or if they don't need to, they end up taking place anyway, and then it doesn't work so well. The reason that we need to do that, or that there is a lot of bailouts for hedge funds, though, I wouldn't say we need to, is hedge funds have end investors. So a hedge fund manager is going to be somebody that makes a lot of money. Huge fees, huge amounts of money that they're being managed. But underneath that, they have investments and they have investors that are answering to them. And it's not just the everyday person a lot of the time, but it's big institutions. It's endowments, it's unions, it's pension funds, it's superannuation schemes. So even though you and I may not invest directly in a hedge fund, the society around us is going to be reliant on them to some degree. In fact, the NZ Super Fund, they're invested all the way around the world. This is a really good example. They're going to have exposure either directly or indirectly into things like hedge funds. So when a hedge fund comes under a bunch of fire and makes some really bad decisions, or even if they make good decisions that just go awry, what side do you want to be on? Would you rather bail them out and then see the end people, who are people that are on the pension, actually taken care of, which also helps the hedge fund managers and the people that messed up? And I think
That's a perfect business. So you can be as risky as you like and someone's going to bail you out.
Yeah, which is exactly what we saw in the global financial crisis.
Yeah, wow. So I was going to, my next question was, like, does this stuff happen in New Zealand? So I suppose it semi-does by the fact that, the NZ Super or whatever may be investing overseas. But do we see this stuff directly in New Zealand?
Not exactly. We could. Anybody has the option, if they sign up for an account that allows shorting, they could do that. They could do that to New Zealand publicly listed companies. They could do that to other companies around the world. So anybody has that option, yes. But what we don't see is the same thing of what takes place in what happened with GameStop. And there's a couple of reasons for that. One, New Zealand is not looked at upon the rest of the world as the number one destination for hedge funds. We basically don't have any. We do have a couple of institutionalized funds, but they'd be so much smaller. We're not talking about billions and billions of dollars. We're talking about maybe tens of millions. That's a much smaller scale. We also have fewer numbers of those funds. And if we look at it in a global context, the US is often pointed to as examples of this. The US is about 60% of the total world's share market. So out of all the countries in the world that have shares on offer, the US is about 60%. And then you look at Wall Street, and that's where all the stories come out of. New Zealand, we're about 0.1% of the total world. So let's say that we had our own version of GameStop here, Ryman or Meridian shares, and somebody decides, we're going to get on a Reddit thread and boost this one to the moon. That's fine. But even so, we can only move the needle so much because the amount of money that New Zealanders have to invest is so much smaller compared to the billions or trillions of dollars that exist in the US. So to answer your question, yes, it could in theory happen, but in reality, it doesn't seem very likely that it would, and certainly not to the same scale.
Yeah, and we'd said off camera, I was trying to get some context to these numbers. So, New Zealand's entire stock market and exchange is worth about 150 billion, you were saying. So there are companies single companies in America that could buy New Zealand's stock exchange, all of the shares, multiple times over.
Correct. Yeah. I mean, you just look at the big, what they call now the Magnificent Seven. All of those companies are so large that those one companies represent more than all of our companies put together in total value, what they call market capitalization. So when you have single companies that are that big, and then you've got another, call it 495 of them in the S&P 500, that's a lot of big money being moved around. Whereas we sit on the other side. So even if we had something that caught the attention of a bunch of US investors, there's simply not enough of it to be traded out there. We wouldn't have the same liquidity so that a bunch of people could get into it. It could drive the price up a whole bunch, but New Zealand isn't really thought of as the first destination for a lot of these things. We don't have the same kind of meme culture and feedback loops that a lot of the other places in the world get a lot of focus on.
Yeah, fair enough. Okay. And so although I'm sure shorting does exist a bit in New Zealand, does it? Do people do the fundamentals of what we're talking about? But it would just never be big.
Correct. Yeah. And shorting is quite risky as an investment strategy because what you're doing is betting on things going down. And this can be explained in some places. Usually a hedge fund will do that, and maybe some other funds as well, or individual investors, once they see a company that is on its last legs. So when a company is going down and it's very clear that there's no recovery, they have no profit, their margins are horrible, their revenue and their sales and customers are all dropping, it doesn't look like there's any going to be a recovery taking place here. That's usually the time that shorting starts to take place.
Yeah.
Here, you could still do that, but it just seems a little bit more vicious. And also because we don't have hedge funds, the reason hedge funds can do this is they're not as closely regulated as, say, managed funds or mutual funds or ETFs or things like that. They can really invest in just about anything they want.
Yeah.
So because of that, they can take advantage of that and the risk profile that goes with it. If the everyday investor, you and me or mom and dad, say, hey, I'm going to be investing. And then they find out that their fund is actually shorting something and the company ends up skyrocketing. So they lose 50% of their share value in their KiwiSaver. That's not ideal. So there's more regulation around protecting the average investor versus the uber wealthy or the endowments or the really big institutions that invest in hedge funds.
Yeah, and that brings me on to an interesting point, actually. So in the movie Dumb Money, and it's called Dumb Money because that's what Wall Street guys call public investing, isn't it? Or...
Correct, yeah. Pretty disparaging. So again, Wall Street's not exactly filled with your most likable personality, so I'll go ahead and put that out there. But it is referred to as dumb money for what everyday people do. Yeah. And then this is going to shock a lot of people. The way that we refer to Wall Street, or a lot of people do, including Wall Street, is smart money. Now, if you look at the statistics on this stuff, it's not as though the smart money really make the best decisions all the time. And in fact, they often do very poorly as investors. They're really good at generating money through fees and commissions and things like that. They are not so good at making long-term investment strategies that tend to outpace. This is one example of that, and this is an unusual event with what happened with GameStop, but there'd be others that would be a little bit similar.
Yeah.
And so, dumb money versus smart money. I wouldn't go by those names necessarily.
No. And on that point, so, we talk about the people then that are behind this. And so they're well cast in the movie. And then in Eat the Rich, the docuseries, it's the people doing it. Mm-hmm. But if we look at the first main character in the movie, the Gabe Plodkin, so beginning of the movie, it says this guy's worth $400 million, personal wealth. He's head of Melvin Capital. Melvin Capital loses $6.8 billion over this period of time. So, what insights do you have into some of these characters?
So, not much. My own personal view. You could do a bit more research on these people and individuals and who they are. My own personal choices, I don't play very much in the world of hedge funds because it's not of interest to me. It's not an access that's available to most investors. And if you look at their track records, most of them aren't actually going to outperform anyway. There's a lot of data that show hedge funds do worse than your typical balanced fund, but you're taking on a whole lot more risk. Gabe Plotkin is one example of a person that manages a hedge fund, and that hedge fund very clearly got caught on the wrong side of a decision at one point. But the profile that you find for someone like him, worth $400 million, that's not unusual. A lot of hedge fund managers are people that are very, very wealthy, and they go into an area where, hey, now I can do an investment fund the way that I want. It doesn't really get as closely regulated, so I can invest anywhere without restrictions, and I'm just going to deal with institutional, sophisticated, accredited, eligible investors. Those are technical terms. It's not a thing where I'm saying smart money, but regulatory bodies give specific definitions. If you have a certain amount of liquid wealth, then you're able to invest in a hedge fund, which is why it's not available to just everybody. So what they can do is charge insanely massive fees when they have a hedge fund and then make really good money from doing that the whole time that they're managing it. So Gabe would be one character that's one of many, and there'd be all kinds of hedge funds out there that would be similar.
Yeah. And he ends up being bailed out by these characters. So another one was the Ken Griffin of Citadel. He was a guy that's worth 14 billion. So again, some context to that. 10% of New Zealand's entire market.
Yep. He's done well for himself. Yeah.
So again, these characters in the movie, are we saying that they're not necessarily even that then important? There are these guys out there, in the smart money field doing this?
It depends what you mean by important. If they affect the lives of you and me and our everyday and what we do, no, these aren't important. They're just people that run a big company in a big industry, and then they're on the other side of the world. Are they important in the sense of the specific strategy or the decisions that are made behind the scenes for things like this? I would probably say yes. There'd be a lot of people like that. Just because we don't necessarily know who they are doesn't mean that there aren't people that don't have an influence on your life. they'd be all over the place. Citadel is a huge company. It's one of the largest companies on the Wall Street side of things anyway. And that's somewhat reflected in a guy being worth $14 billion, making huge decisions about a hedge fund that they run and what they're going to invest in, what kind of strategies they take on, and also what sort of influence they play over other companies such as Robinhood or brokerage platforms, and when people can invest and when they can't, which becomes very controversial in a situation specifically around GameStop. But there would always be some kind of influence about those kinds of things anyway.
Yeah, as you've mentioned it, I'll use the segue. So, Robinhood, can you talk to us about that?
You mean biasedly or unbiasedly? I'm going to struggle.
Give us your feelings. Yeah.
Robinhood is a brokerage platform, much like what we have in New Zealand. We have our own versions of it, but in the U.S., again, because the scale is different, the U.S. is 68 times the population of New Zealand, so a little bit bigger. So Robinhood is a trading app as opposed to the traditional medium. When people would trade investments, they'd probably do it on a computer. Robinhood's main focus was to do it on a phone, and they kind of gamified it. They made it a little bit more fun so that when you sign up, you get a free share of a company, your friend gets a free share of a company, and it looks like a scratcher ticket, so it unwipes and you can see which share you've won. When you make your first trade or any trade, confetti blows out, so it makes it a bit of a celebration. And all of these little things that are taking place are slowly found out because they're designed by behavioral scientists. It's interesting that a lot of brokerage platforms, a lot of their R&D budgets go into behavior science. And I find that interesting because why would a brokerage platform that's all about investing go into behavior science as opposed to, say, market research? Part of the reason is because they get paid not based on people making smart investment choices, which is a little weird. They get paid because people go onto the platform, they engage it, they give their attention and focus, but above all, they trade. They make buys and they make sells. That is how they get paid. And here's where it's a big conflict of interest that everybody should know. And we're talking about Robinhood, but this is also true of any brokerage platform, quite frankly. There's good and there's bad that goes with it. You're democratized, you're open, you're able to invest then a lot more freely and easily. But if my incentive is now to place more trades, that's how they get paid. It's not how I make money. Mm-hmm. If you look into the data, and they've done this many times over, there's a famous study out of the US by Terry O'Dean and Brad Barber, and they've shown that people that trade most frequently in their brokerage and investment accounts usually underperform compared to people that do a buy and hold strategy, somewhere between 2 and 4% a year. Another guy named Meyer Statman did it in Sweden, found the same thing, but the numbers were even higher. People underperform by something like 3 to 5%. Now that doesn't sound like a whole lot. You're talking about over a 1 year period, the difference of $103 versus $105. But the problem is you compound that over years and years of time. You're talking about having the difference of 2, 3, 4 times the money over the course of decades. So trading is not something that is beneficial for people. It's actually detrimental. It hurts your returns a lot of the time.
So an app that it gamifies and just rewards with confetti and all of this is all about trading.
Correct. And anybody can test this. Next time you log into a brokerage account that you have, see how much information on there talks about what your account's return has been ever since you signed up. And I'm not talking about the individual investments within there. I'm talking about your overall account return. Yeah. If you accounted for every single investment and how much it makes up since the starting point, what has your return been? And that's very easy to track. I mean, anyone can do that in a spreadsheet. So why don't brokerage platforms actually have that on there? One of the answers, potentially, is because as soon as you put that on there, it's very easy to see, oh, I don't have a very good return after all. This whole trading thing isn't really working out. Maybe I'm going to try something else like buy and hold, which works much better. Also look at the arrows. There's going to be arrows pointing down that are red, arrows that are green pointing up. That's because psychologically they're tapping into human weaknesses that are greed and fear.
Yeah.
And greed and fear are two very powerful motivators for what we call bias to action. It's, hey, I need to do something because either FOMO, I'm missing out on some opportunities here when everybody else is making money, or I want to protect my money because it's going down, so I need to trade out of it. These are the kinds of things that people tend to do, and this is where a lot of the money gets sunk in from brokerage platforms figuring out how do we get people to engage so that they can feel these heightened emotions and start trading a little bit more.
Wow. Yeah. I mean, I look at it with, I think we were talking a few months ago about my Sharesies account, and I just, compulsory saving, put money in there, and really because for me, I wanted to understand it. So, and I just can't find the information in there that I want. I'm like, I've logged in on the computer and I'm like, right, where's the reports section? Nope.
Yeah. And it depends what information you're looking for. If you want to see the return of a specific share or investment, you can probably find that relatively easily. But if you want to find how you as Rick, the investor, has done overall, that's going to take some manual calculation.
I can only see it from inception to now. And I'm like, right, so what's that worked out on year by year? I will be able to download that. Mm-hmm. Nope. So, because really, 50%, cool, that's great. Oh, it's over 3 years. Oh, it's not great. Right. So, just trying to work this out. So I totally understand what you're talking about. And I'm not bagging Sharesies here, but perhaps some more reporting functionality would be nice.
Yeah. And again, it's where information is one of the most valuable things. So as you're more aware and accessible, you can get that information more easily. It creates a different frame of mind. Now you're thinking about, oh, has my strategy actually worked? Or should I be trying something else? Because it's very clear what the best investment strategies are. Buy and hold works better than a trading strategy almost all the time. So of people that do day trading, 97% of them lose money. The 3% that do outperform, only 1% get paid anything more than minimum wage. Now, this is based in the US, where minimum wage looks different than New Zealand again, but it's still kind of worth noting that most day traders are going to deplete their wealth, and the very few that do better aren't going to do all that much better.
Wow.
So you're talking about a lot of risk where you can lose, but not very much where you're likely to gain.
Yeah, fascinating. Right. Back to the movies in the docuseries. Okay, so one of the main people in this is what's his name? I called him Catman. It's the
Roaring Kitty.
Roaring Kitty. That's the one, right? So he's a dude that kind of broke the mold of what you're talking about here as a day trader. I don't know how sustainable it was. Can you tell me a bit about him?
So, Roaring Kitty, a real guy in the US. If anybody wants to know anything, you can go, there's a regulatory website in the US called FINRA, and they have something called Broker Check, where if you are a registered person that works in financial services in the US, you'll be on Broker Check. It's their way of licensing and having your level 5. So you can look up his work history and see what kind of actions he's brought against him. But he's a guy that had 2 different disconnects, or maybe 3 personalities. He had a Reddit thread, he had a YouTube channel where he was somewhat of an influencer / entertainer, and then in his normal day job, he was a securities professional, which doesn't really say much about what that means. That could mean anything. It's just like saying a person that works with numbers, maybe. It's a very vague statement. But what he ended up doing was he bought shares in GameStop. It ended up plummeting, and he kept saying, oh, I think this is going to be a really good thing. And he kept creating content saying, oh, everybody else should be buying into this. If you haven't spotted the conflict of interest yet, just wait. So the point is that he's invested in this and wants other people to be invested in it. It's a little bit like how when you're having a good time, a bottle of wine, and you want your friends to have some wine with you. You want to share in that experience. The problem is this is also dealing with people's wealth and investment and their savings.
And if you're selling them the wine, there's a conflict.
Yeah, there we go. So what he wanted to do was see the value go up, And it did. A couple of small catalysts took place. Another guy named Ryan Cohen bought some shares in the company, and that really created the starting point for what it needed to take off. And he continued to benefit from that. And then in the very end, somebody needed to be blamed for why this crazy event had taken place, and he got a lot of flack for it, for better or for worse. I mean, when it comes to investing in things like GameStop, there's a lot of characters involved. My own feeling is that nobody is a perfect hero and nobody's a perfect villain. Everybody has incentives that they're responding to, and everybody's made some mistakes. So
yeah. We spoke about this, where he's portrayed as a bit of a perfect hero in the movie Dumb Money, but yeah, with you saying that he's already invested, and actually, seeing the conflict, it's or having you explain the conflict does make it more obvious. The other thing you'd said is where these guys are out there just fighting Wall Street. Again, they're the people's people, they're the heroes, but like you say, they might be bankrupting pension funds.
Exactly. And that's where it gets so complicated, where, hey, hedge fund managers are people that have a ton of money and they're making decisions that could potentially deplete a lot of other people's money. That's a problem. We don't really want to promote that kind of thing. But on the other hand, if the everyday retail investor tries to take them down, they could inadvertently be hurting themselves as well as the people around them and in their communities. How do you deal with a situation like that? It's a little bit better in New Zealand. We don't have quite the same complexities. Things are somewhat more straightforward, but we're not totally disconnected. The global financial crisis started mostly in the US, but do you know anybody that didn't feel affected by that in New Zealand, whether in the share market or the real economy in their everyday work life? Over here,
it trickled through.
It goes all over the place. Yeah. It spreads. So there's a couple of things to bear in mind that how do you fight something when it can have an effect on you and you don't know if that effect is going to be positive or negative? That's a scary thought.
Yeah. And it comes down to, like these, it was gambling for these people anyway.
Yeah, it really was. And there's a big difference where it's hard to recognize this exactly. It's not a black and white yes or no, but there's a difference between speculating and investing. Think of it as more of a gradient or a spectrum. So you move along that scale. Investing is something where there's principles behind it. It's evidence-based. You have data and reliable facts and figures, and you're making decisions that put the odds in your favor. Speculating says the odds are not in your favor, but you could make a whole bunch of money if you get it right, and you could lose everything if you get it wrong. So what you've done is you've magnified your outcome so that the highs are much higher and the lows are much lower, but the odds go down because of that. Another way to think about it is gambling. Gambling, you can make a ton of money, but that is speculation. Investing is a very different thing where if you just made a very simple decision, hey, I'm going to invest in everything in the world, super plain, vanilla, low cost thing, and I'm just going to hold on to that for 10 years. The odds are in your favor, you're going to make a lot of money. But if you say, hey, I'm going to pick one individual company and I'm going to try to go against a hedge fund, or I am a hedge fund and I'm in short it, those odds are not very good. So you're really taking on a whole lot more risk by doing that.
Yeah, definitely. Excellent. Well, look, I think we've covered this movie and this docuseries really well. Is there anything you want to add to? Look, I'd say go watch these if you haven't already. Right, they are so entertaining. And I know it seems a bit geeky watching a full feature-length movie or docuseries about one particular stock on the American Stock Exchange, but my God, it's entertaining. So
it is. I would probably just wrap up with the same thing. Give them a watch and then see what your reaction is to it. And I think that's a little bit telling. It's very easy to feel tribalistic, like we identify with one group over another, but look at it as objectively as you can. How are you thinking about this investment based on what you watch on those movies? And that might inform a little bit about how do I actually feel about investing? Do I want to speculate? Do I want to invest? Am I for the little guy or the big guy or whatever it is? There are sides that people are going to want to take, but it's always interesting to watch something for the entertainment value and potentially learn a little bit about yourself and what sort of investment style you believe in.
Yeah, perfect. Thanks, Cam. Awesome.
Yeah, thank you.
Well, hey, hopefully you enjoyed this episode of Sidekick TV. I realised it was quite different to our normal one. But the reason I wanted to do this one was because, again, I want it to be educational for small business owners and self-employed people in New Zealand. And I really do want our clients to be, diversify their investments. So it's not just in their own company or in their own income or house, So learning and understanding more about this hopefully gives you the tools to, be more educated in that investment strategy before retirement and post-retirement, actually. So, hey, thanks so much for watching. If you've enjoyed it, like I say, like here, subscribe where you've watched or listened to this. So thank you. Cheers. Welcome to Sidekick TV. I'm your host, Ric Thorpe. Sidekick TV is the place for Kiwi business owners and entrepreneurs to learn all about finance, accounting, and how to run and operate a business in New Zealand. We're going to interview experts from the finance realm and fellow Kiwi business owners. Stay tuned.